And let's talk about lease rates for just 1 second. I'm a jeweler and I need this contract, right? I need this gold bar to make my jewelry. And so I buy a contract and I know that I can stand for delivery. It's going to take T+1 in 3 days. I'll have my gold. What do you mean it's 8 weeks? I have orders. What am I going to do? Well, you can lease a bar from an LBMA member. Now the lease rates have gone parabolic from 20 basis points to 6%. Well, that doesn't make it very appealing, but okay, I'll do it. So I lease that bar, give it to the manufacturer to make my jewelry. In 8 weeks, hopefully I get my bar to pay it back and I'm made whole. Well, okay, check, check, check.
In today's news recap, gold has a win-win setup, but not for long, while silver is the squeeze you can buy. TD Securities golly. Gold prices are uniquely positioned to gain regardless of what the U.S. dollar does in the coming weeks, while silver's physical flows and structural deficit could make it the long-term winner, according to TD Securities senior commodity strategist, Daniel Golly. In a February 21 interview, Golly said that even as Washington considers depreciating the U.S. dollar to make exports more competitive, the strength of the greenback is actually helping to boost gold prices. What's curious about this current stage of gold's rally is I actually think that a strong U.S. dollar is contributing to the strength in gold prices. He said, one of my core beliefs is that we can learn a lot more from anomalies in markets than we can from what markets are actually supposed to do. Golly said that gold's epic performance over the last year has been quite anomalous. Gold has rallied despite U.S. dollar strength and periods when U.S. rates were rising as well, he noted. Gold has actually only ever had this good of a performance alongside a strong performance in the S&P 500 twice in history. The first time would have been 1933 when the U.S. government decided to revalue gold. The second time would have been 2009 during the largest round of quantitative easing at the time. He pointed out that gold has also never had a run this strong absent a U.S. dollar bear market. So clearly the strength in gold prices is a market anomaly. And I think it's telling something for those who are willing to listen. Golly believes the yellow metal has taken on a new role. The strength in the U.S. dollar is acute enough to catalyze buying activity in gold as a currency depreciation hedge, particularly out of Asia, he said. This is a trend that we've seen develop over the last 2 years and has come back to the fore as of January of this year. Tariffs are another area that remains top of mind for precious metals traders, and Golly addressed the latest developments he's seeing in physical flows. It's an epic distortion in commodities markets that is currently hiding behind the rising gold prices, he said. It's not necessarily all that relevant to gold prices per se, but under the hood, the return that you can earn from moving physical gold from London into the U.S. has been abnormally large over the last months. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps.
Satisfied delivery on a COMEX contract, chunk silver does not qualify like a kilo of silver bar would, or a 100-ounce silver bar, or a 1,000-ounce silver bar. And so they pulled it out of reportability in terms of requirements by the dealer. None of this takes away the client's obligation to do the reporting. It just means we won't do it on their behalf. And, you know, that's another example. Not only is silver, you know, historically undervalued, not only is the gold to silver ratio historically out of whack, following the same thing I've just been saying. But these things are happening at a time when the biggest money in the world is rushing and scrambling to acquire physical metal and hold it themselves. I mean, and yet the public is asleep. I've never seen an environment like this ever. The things that are happening on COMEX and the LBMA, it's unbelievable. And it's almost as if this giant Ponzi scheme of rehypothecated gold and silver is coming to an end. And that's what's, you know, interesting. At the same time, you got Warren Buffett, who's sitting on, 334 billion in cash. He has right now 286.5 billion of short-term treasuries. That's 91 billion more than the Federal Reserve has. And this is the greatest value investor of all time, who has no interest in holding securities. I mean, he owns some still, but it shows you his mentality. Everyone is flocking at the Trump trade, and you have the most legendary investor of all time having more cash than just about half of in fact, more cash than all but, in terms of market cap, his cash balance is larger than the market cap of all but 30 public companies in the world. What does he see? And why are we seeing such a massive drive to accumulate metal? And it's interesting too, because I asked AI, just for those people who haven't heard this, I asked AI, because everyone's saying, well, there's a whole new thread out there, that we didn't talk about, done again last week, about what I thought this gold coming back was for. And there are people like Tom Luongo who will tell you this is being done to blow up the Bank of England. I'm not saying I believe that or not. It's intriguing that Trump is angry that he found out it was the aristocrats in England that were behind all of these problems with him, with the election, and that he's trying to get back at them by exposing this fractional system in London. And the rumor is that the U.S. banks in London are now long. I can't substantiate any of this, okay? I don't mean to spread innuendo, but if that were true, it would be very interesting. And I asked AI, what would be signs of the LBMA breaking? The first thing that said was widening divergence between paper and physical gold prices in indicating delivery stress. Well, it was at $82 an ounce difference. I don't know what it is now, maybe 30, 35, where, in other words, you can buy a contract in London and sell one in New York and get that arbitrage. Well, that's what a lot of people say that this is about. It's the arbitrage. And I don't believe that. Yeah, it's enticing for a trader to do that, but the cost of shipping it across the globe kind of pulls the incentive away. The second thing it said was reports of delayed deliveries or contract settlements. Well, okay, it's supposed to be T+1. It's now T+8 weeks. And the Bank of England says, well, we don't have enough trucks or manpower. Really? You don't have enough trucks and you're the Bank of England, right? You couldn't just go rent every truck from Ryder and U-Haul and whoever the hell you have to rent it from in London to do this? Don't believe it. They also say, well, some of it is refining backlogs. No, it's not. Because number 4 was major disruptions in supply chains, including mining, refining, or transportation. So check, check, check. And then the other one, number 3, was unusual gold lease rate spikes, reflecting increased borrowing costs for physical gold. They've shot through the roof. They were at 10, 20, 30 basis points. They're north of 6% now. So all of these things have happened. The last one that hasn't happened would be what Tom Luongo is saying, trying to blow up the LBMA and the member banks, and that many are saying that the U.S. banks are kind of flipping the script here and are going long there, which I can't validate. But the last one is banking sector instability affecting LBMA member banks or clearinghouses. So how close are we to a default? Could it really be that is what the idea was to, he says it started with the flipping of LIBOR to SOFR, and that was his signal that this was beginning to happen. And then everything he's done since, draining the gold to silver out of a situation where, if we look at give you the number, I often talk about silver, that they have 300 million ounce float trading as much as, they say 290 million, but they say it's 10 times understated. So 2.9 billion ounces of silver off of 300 million ounce float. I couldn't find gold, but I did now. And for gold, they have total of about 279 million ounces on paper stored at the Bank of England on behalf of the LBMA, of which only 36 million ounces are available, right? The float is 36 million ounces against 380 million ounces in outstanding contracts. They're about 90% short on their ability to deliver, but it's just trucks and men, right? So could it be Could it be? I don't know. It seems a little bit out there, but Tom, who is a brilliant guy, is basically saying this is his way of, in essence, blowing up this paper scheme. And if we reshore all of the gold here, I don't know. I just want people to understand that it's a whole lot more than just Trump tariffs or trying to take advantage of arbitrage and the possibilities, whether it be gold revaluation, whether it be blowing up the banks in London who Gordon Brown sold almost all of their gold. So you revalue the price of gold. Well, it ain't going to benefit London, the UK. I know it seems a little bit out there, but I'm just passing on information that I've heard because it's interesting to let your mind expand a little bit and think, because look, we're at a place right now where desperate times call for desperate measures. We have $28 trillion in U.S. treasuries that are due in 3 years, Dunnigan. In 3 years, it's $28 trillion to get the tax revenue will be under $15 trillion. And so you take all that tax revenue over the next 3 years, even call it $5 trillion a year, which is under that now, and he wants to lower taxes, but give him the benefit of the doubt. $15 trillion, even cut some spending and all that stuff. We owe $28 trillion. So we're halfway there, and that doesn't account of all the debt we accumulate over the next 3 years. We're already at over $800 billion in debt for this year, and it's only February. So the moral of the story is, how do we address this problem? And so, look, desperate times call for desperate measures. Where does gold fit into all of this? Don't know, man, but I think people should don't be surprised when you're surprised as to what shows its head in the coming days and weeks ahead. I think it will be something a little bit more grandiose than what the media is leading us to believe.
What do you think about Andy Schectman's insights on the BRICS nations, the silver squeeze, and the potential explosion in gold and silver prices? Are we really on the verge of a massive shift in the global financial system? Let us know your thoughts and predictions in the comments below. Do you see silver and gold skyrocketing soon, or do you think the squeeze might ease up?
Don't forget to hit that like button. It really helps out the channel. And if you want to stay updated with more content like this, be sure to subscribe and click the bell icon so you never miss a video.